welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank by applying the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sari Ibrahim. Today, I'm interviewing Emmanuel Daniel. He's a global thought leader in the future of finance, an entrepreneur, writer, and listed as top 10 global influencer in the Fintech Power50 list for 2021 and 2022. Much of Emmanuel's writing covers the future of finance, with a special focus on how cryptocurrencies, blockchain, gaming, and other technologies are opening the doors to new transactional opportunities. His next book, The Great Transition, The Personalization of Finance is Here, covers how the US has shaped worldwide financial innovations. Emmanuel travels widely and has visited more than 100 countries and is working on his next new book called The Winning Civilization. As an entrepreneur, he was previously a member of the Entrepreneurs Organization, a prestigious grouping of young business owners worldwide. Emmanuel was trained as a lawyer, has degrees from the National University of Singapore and the University of London, and attended a course on economics at Columbia University in New York. He travels widely and divides his time between Singapore, Beijing, and New York. Emmanuel, welcome to our podcast.
Thank you, Sari. Thank you for having me on. It's great to be on your program. Let's see if we can match, your audience with the core message that I have in the back of my mind, which is the personalization of finance.
Personalization of finance. I like that term. I wanna talk more about that. But before we jump into that, I want to know more about you and your background.
Okay. I grew up in Southeast Asia, and I'm the founder of a platform called The Asian Banker. I set it up 28 years ago. I have offices in Singapore, Beijing, Dubai, London, and basically because of the rise of Asia. The banking industry, is the backbone of many economies.
Mm-hmm.
And through this platform, I was able to also interact with, any number of leading personalities around the world, because all of them were also interested in Asia. So if you look at my book, for example, the foreword was written by Barney Frank, the congressman, who co-authored the Dodd-Frank Act, which states the banking industry. So these are people who I've been able to build relationships with, and the foundation of the relationships really their interest in Asia, and then it becomes a global opportunity for me. And in that process, I can land in any country. Almost any country in the emerging world, and I would tend to meet with regulators, central bank governors, and the chairman or CEOs of the major institutions. And so from there, I cultivated a huge repository of ideas that went into the book that I've written, which is on the future of the banking industry.
Now, the future, and I think it implies like the future of the banking industry, that it's what's going to change, right, about the banking industry in the future. Is that kind of the idea or the message of the book?
Yeah. So when we think about the future of the banking industry, I was trying to write it for the layman so that ordinary people will understand where the banking industry is going. But I had to predicate that on what the essence of the banking industry is, the DNA of the industry, and how that DNA was transitioning from its traditional roots into digital banking, and then how do you think about all the innovations that are coming in, such as cryptocurrencies, blockchain, gaming, and so on. So there's a whole new economy being created out of virtual finance, if you want to give it a name. So one of the things I say in my book is that financialization is becoming an important part of the economy. And financialization is about a esoteric part of the economy. So it's not the real economy as in production or services. It's the financialization of the data, the information, into virtual assets, as it were. So something for your audience is that the whole idea of wealth and assets is becoming increasingly ephemeral. Ephemeral meaning the whole idea of financial assets is not predicated or doesn't have a underlining, a solid underlining asset backing it. But it's basically assets created on the derivatives of assets. And that's happening because, for a very simple reason, and this is something else I say in my book, anything that can be digitized can be financialized. So you take a company like GE, for example, in 2013, I think Jeff Immelt said this, that that GE's core business is moving from manufacturing towards the data being generated from manufacturing. So by creating many, many data points, the whole idea of an industry or a business is to be able to financialize that data, to put it out there in the marketplace, to have it traded. When you think about Tesla, the car, it's basically a data machine. It generates huge amounts of data, find its way into into the insurance industry, into new forms of assets, into the capital markets, and so on. So the GDP of entire countries, and especially the United States, because again, I think it was about 2014 or so, the Bureau for Economic Analysis modified the definition of GDP to start including these ephemeral assets that are being created. So the US economy is not just about production and services, but it's also now more about entertainment, about virtual assets, and about financialized assets. So the financial component of the economy is becoming an increasingly important aspect of it. Now, what that means is that all of us would think about wealth, need to think not just about property, but also about ephemeral assets, virtual assets that are now as important as physical assets.
That's an interesting point. I do see a lot of differences especially with the crypto. You mentioned something earlier that was kind of like it resonated with me a little bit. It was an important topic I want to talk about, the Dodd-Frank Act. I know that kind of really changed the banking. And correct me if I'm wrong, but that happened around 2008, right?
2010, yeah.
2010, okay.
About the time. It was as a result of the 2007, 2008 US banking crisis that eventually became global. And the Dodd-Frank Act had many components into it. They tried to solve a wide cross section of issues, and one of them was trying to separate traditional banking from capital markets, for example, and to make sure that the depositors are not put at risk, because banks increasingly have become trading shops. They just take deposits and lend them out. They also trade those deposits. So there are many different parts to the Dodd-Frank Act. But the most important aspect of it is to ensure the safety and soundness of the Main Street banks as opposed to the capital market or the New York banks. And then there were other aspects to it, such as consumer protection and how to ensure that consumers are protected in the event of a bank failure. And then based on that, yet another layer, which is trying to prevent systemic risks in the banking industry. What is a systemically important institution and what's not. Interesting. I mean, it's a whole range of structures put in place as a result of the Dodd-Frank Act. And some of the work is still ongoing today. So
Yeah.
one of the things that happened in the last year, or rather last 6 months,
Yeah.
was the fall of Silicon Valley Bank. And so Silicon Valley Bank was not a systemically important institution, and yet, if they had let it to default on its depositors, it would have created a systemic risk that would have reverberated through the economy. So the U.S. banking system is highly structured, and there are many different moving parts.
Hmm.
And so it's an ongoing story. What happened in Silicon Valley Bank recently. Now, the interesting thing there is that a lot of what's happening in banking today is the result of the digitization of banking, the introduction of digital banking, and the speed with which transactions can take place today. And that's a new dimension that didn't exist in the 2008 crisis.
That was actually my next question. My next question was what happened with the Silicon Valley Bank. Do you mind? Because I know that those listening to this podcast, they know what happened to Silicon Valley Bank. In essence, it went out of business. But do you mind kind of considering your background in economics and banking, do you mind explaining a little bit more in detail what happened with Silicon Valley Bank?
Yeah, I mean, the Silicon Valley Bank story has several facets to it. So, um, and that's something that I talk a lot about in my book, which is that traditional banking is very beautiful. It's about taking deposits in the cheapest possible way, from your local community, and then deploying that deposits to lending. And Silicon Valley Bank, like many banks in the U.S. Do this very well. Does this very, very well. They go out there and have a very strong relationship with their depositors. And in the case of Silicon Valley Bank, and also like First Republic, they tended to have very specific classes of depositors. So in the case of Silicon Valley Bank, it was the VC community
Hmm.
in the Valley. First Republic, it was the ultra high net worth investors in the area that it was operating. So it was both geographically and also the occupation of its depositors, very, very specific. Now, these banks grew very quickly because the depositor base was increasing dramatically,
Hmm.
and therefore they were not able to invest the deposits that they were gathering, fast enough into the lending business. Now, something that has to be also said is that the best banks in the old days, when they were very good at collecting deposits in the cheapest possible way. Now, when the bank is able to collect depositors in the cheapest possible way, it also denotes a very close relationship with its customer base. And actually that makes for a very stable bank. And there are many, many cases in the old days where these banks will take these cheap deposits and instead of lending them out, would actually invest them in treasury bonds,
Hmm.
in investable assets on the capital market, and that's it. They got their returns from those investments, and then they pay the deposits, and the rest of it is profit. But what was happening in the last year was that because treasury rates were going up very, very quickly, that when the treasury assets that the banks had invested in were losing their value very, very quickly because bonds are like,
Hmm.
the more if they go, the less returns you get. And all of that is a balance sheet problem, meaning that if everything is stable, they're able to resolve that eventually. So when the rates come down, they can hold their securities for as long as possible and then have them sold at maturity. But because we now live in a digital world, it is very, very possible, and that's what happened in the case of Silicon Valley Bank, on the strength of a tweet from Peter Thiel, and almost the entire VC community in the Silicon Valley area wanted to withdraw their deposits almost instantly. And when they want to withdraw their deposits almost instantly, the bank has to look at the asset side of the business and look at what the valuation of the assets are. And then they find that there is a mismatch in the price of the assets and the cost of the deposits, and that had a huge hole in the balance sheet. Now I'm telling the story at as if it's a point in time, but it was already a 1 year problem at the time that the events that triggered the dismantling of Silicon Valley Bank. And at that point in time, on the strength of a tweet, when a lot of depositors wanted to withdraw their money, the bank was technically insolvent, and so the regulators stepped in, and it had many repercussions. The first repercussion is, did the regulators see this coming? Was the bank doing anything that was out of form or dangerous that that it shouldn't have been doing? For the most part, Silicon Valley Bank was doing what all banks do, taking deposits as cheaply as possible and have it invested. And the most secure investment that the bank could do at any time is treasury bonds, because the U.S. Treasury bonds are the most secure of assets. And yet, it was exactly the treasury bonds that caused the trouble that Silicon Valley Bank suffered from. And First Republic is the same story. And when the regulators started looking at all the other banks across the country, there was at least 16 other banks which had the same problem. Which, in other words, they were technically in default on their balance sheet if you were to call in all of the deposits at the same time. Now, this problem would not have existed if there was no digital banking, because the idea that everybody can withdraw their money instantly, almost on a Sunday afternoon, so that on Monday when the bank opens, it is technically insolvent, didn't exist in the past. In fact, on the Monday that the bank was closed, it was a Friday, and then on the Monday when the resolution had to start, the reporters went around looking for queues at the bank branch, and there was no queue. There were only a people hanging on outside the branches because everybody else got their money out digitally, right? So now this puts into great relief the whole idea of what digital banking is doing to the banking industry today, and the story is only going to get worse because of digital banking. The ability of banks to manage their asset liability mix, the cost of funds, to resolve problems quickly is becoming an increasingly difficult thing to do.
So overall, digital banking is worse for banking than it is good for banking?
It introduces new problems that banks to start thinking about and start developing infrastructure to be able to resolve them. But guess what? When you look at what's happening in decentralized finance, which is not regulated at all, and able to do in decentralized finance, a bank's treasury position, for example, in other words, the job of the bank treasurer to make sure that the funding mix of a bank is sufficient for every day's operation. So he has to do this every day. Can be reduced into a small algorithm that can automate the process of managing the funding mix for any one day, and that's done automatically in decentralized finance. So and decentralized finance is 24/7. Banks 9 to 6, and then they day, and then they close for the weekend. They close on public holidays, so they have downtime that they can use to resolve any of their issues. But in decentralized finance, it's 24/7, and the technology already exists to be able to manage a bank's funding base, assets and liability mix, and also the systemic risk, which means that banks net each other in terms of what they borrow or they lend to each other. All of this needs to be managed in a dynamic manner, and the technology exists, and the need for investing in the technologies that enable them to do this is very important if they are going to continue, building their instant banking services to their customers. And in fact, this is also one of the problems that arises as a result of FedNow, which has just been released. The Fed has created a payment infrastructure where ordinary people can pay each other instantly. And this is a great departure in the US from the days of checking systems, where when you write a check, it takes at least 3 days to clear. And so now you and I can send money to each other from our bank accounts to each other instantly. So so digital banking in that way, in as much as it's being made more comfortable and more consumer oriented, introduces a lot of these systemic risk problems.
Got it. And then the instant payments you just mentioned, how is that different from like Zelle or QuickPay, where I could just instantly send you money from one bank to another bank?
Yeah, so Zelle is a simpler version of FedNow.
Okay.
And Zelle is between participating institutions, and it's not real time. So a bank allows you to take on a certain amount of payments, and then it actually batch processes it at the end of the day. So
Oh,
it's what
gotcha.
happens behind the bank that is very, very insecure, actually, because the banks can only know their real asset liability positions when they do their batch processing at the end of the day. So they're actually taking a risk when they give you access to your funds and honor your transactions at the time that it's taking place. So you see that your money has been processed, but the processing is still taking place at the back end, with the banking system. In fact, now the Federal Reserve Bank provides the infrastructure for banks to clear with each other instantaneously. And then it provides the liquidity to make that possible as well. And so it's not dependent on the bank's back-end infrastructure. In that regard, it's like the batch processing has been moved from the bank to the Federal Reserve banking system in order to enable people the user to feel like he's able to complete his transactions instantly. Now in that regard, the US is actually just catching up with the rest of the world, because instant pay is available in so many different countries. The US is one of the last to institute this infrastructure, and the reason it's been one of the last is because the legacy infrastructure in the US is too well developed. The credit card system, the check processing system, is actually revenue generating for many businesses that participate in the infrastructure. So for these businesses to give up what they have is really very difficult. You almost have to legislate it to be able to embrace new technologies.
Yeah, I see that. Yeah, I agree. I think it's similar to, like, people ask, why doesn't the US have a railroad system like Europe does? And the answer is because land is way more expensive in the US. There's way more regulations, more private ownership of land. So because of those legacy issues, it creates like a hurdle for other innovations and other technology, even though the US has, like, the biggest GDP and the probably more likely to do this innovations, there are other hurdles in place.
That's correct. Yeah. So the thing about railroad, for example, is that it's also the ruthlessness of the big corporations. So they're not going to allow railroads, and especially socialized railroads, meaning subsidized by the state,
Yeah.
to take over very profitable big businesses. So the airlines,
Yeah.
and so on, they're not going to give up that part of the business easily. They will resist, they will push back, they will dilly
Write
dally.
new laws. Yeah. They'll write laws
Right.
that
And
oppose that. Yeah.
you see that in California. It was interesting. I actually hosted the chairman of Wells Fargo, Dick Kovacevich, in China several years ago. I think it was 20 something, 2013 or 14, and we to put him on a train from Shanghai to Beijing, and the train was like 250 kilometers, like 200 miles per hour, and sorry, no, 250
Hmm.
kilometers an hour. What's that miles? It's about there, right?
Yeah.
Now, um, and and uh, and he enjoyed the ride. And California was trying to build a high-speed railway, which is like half the speed, and it would cost them $50 billion
Hmm.
only. Okay, and he said we can't afford it, and that's not true. I mean, the U.S. is a country that spent $9 trillion bombing the hell out of Afghanistan, but can't afford $50 billion for a high-speed train from California from San
Oh,
Francisco to Los Angeles. You know,
yeah.
so
Nah.
it's a matter of choice. It's a matter of priorities. It's a matter of how a society holds together.
Hmm.
So um, yeah, and that was a bizarre experience. And to think that China has built I think it's now 20,000 kilometers worth of 20,000, right? And it can build another 10,000 within 5 years or something like that. 20,000 kilometers worth of high-speed railway within 10 years. And so I think the US is a very different beast
Yeah.
in terms of infrastructure, the money that is available for infrastructure, and the way in which big corporations, stymie the process because whatever they're doing, if it is profitable, they're not going to allow new innovations to come on. So it's interesting. It's a country that introduces new innovations, but it's also the country that that holds on to a lot of legacy.
Yeah, I mean that it's definitely an eye-opening conversation, right? I never really looked at it from that perspective. Um, what's your mission? Like, what do you hope to change in the world or accomplish? I know you've already accomplished a lot, but what else do you hope to kind of like your mission, um, for people?
Right by writing these books, I want to help, the industry to think through how, the transformations will come into place. But also, as I was writing my first book, which is, the Great Transition, the personalization of finance is here, I realized that if finance is personalized, entire societies are going to be personalized. And so my second book is on the winning civilization, which is how countries compete with each other to be the most innovative countries of the
Hmm.
future. And there's an underlining theme that is similar in finance, which gets carried into society, and that is that in finance, money at the end of the day is a form of information. And
Right.
this code, but money as a form of information, was first, the person who actually first encapsulated it was Walter Wriston in 1969. And like if I send you money, I'm actually sending you a piece of information. And if I can send you a WhatsApp message for free, I should be able to send you money for free. And that's what money has been reduced to today. And that's the revolution that the banking industry is going through at the moment. But that also has repercussions in terms of information as an important asset in society as a whole. And so extrapolating that, what I'm saying also today is that the societies that handle information in the best possible way are the societies that are going to be leading into the future. And what the US has as an advantage is that it is liberal about information. It is
Yeah.
transparent about it. It's laissez-faire about information. And almost every other country in the world wants to control information. And that's exactly what you don't do if you want to be a leading country in the world. But the problem with being laissez-faire and liberal and transparent about information is that it causes incredible amount of upheavals in society as
Yeah.
different parts of the society try to hold together. So I think that and that is why I say that the US is the firstborn child of the information age.
Yeah.
Therefore, it bears the brunt of everything about the information about information as an infrastructure in society. And as an infrastructure in society, one of the industries it affects is finance.
Mhm. These were all such really interesting points. I never really connected them these ways. Thanks for sharing them, in all these ways. How can the listeners connect with you and learn more about you and your mission?
Yeah, thanks, Sari. I'm very simple. EmmanuelDaniel.com, my blog page, and then from there you can find everything else that I do, including the business that I run. And I actually spend a lot of time these days with specific corporations, helping them think through their strategies in the future of finance a lot, but. And I'm also hoping to do more work in geopolitics and in industries that are not just financial services, in focus.
Thank you very much, Emmanuel. I'm looking forward to having you back on the podcast in the future.
Thanks, Sari.
To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN, assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.